Now to our next conversation. The Central Bank of Nigeria's Monetary Policy Committee is set for its final meeting of the year, where deliberations on the next policy direction going into 2023 will be made. For analysis now, we have Kelvin Emmanuel, CEO, Dairy Hills, joining us via Zoom. Great to have you on the program.
Good morning, Ladi. Thank you so much for having me.
Good morning. So it's the D-Day, decision day by the MPC, and we know the CBN has been trying to mop up excess liquidity. You know, we got that report yesterday about M2 hitting about 50.5 trillion. Seems high. What do you think drove that?
So, you know, the M2, which is like a combination of cash, check deposits, and convertible notes, hitting 50.5 trillion should not surprise anyone. The reason is because if you look at the fact that the CBN has consistently violated ways and means lending through Section 38 of the CBN Act as amended in 2007, and has basically created out of thin air through quantitative easing $49.2 billion, because according to the CBN bulletin, in the month of September, the governor of the central bank still advanced the federal government 749 billion naira from that window. So he's not stopping. He keeps giving money. Basically what they call helicopter money in a kind of expansionary approach towards the economy. The problem with that is you have so much money circulation, which has hit a crescendo, and you want to convert it into a 40-year government bond. And you have a situation where there's so much cash in the system, eating up the economy, chasing too few goods, and inflation continues. Double digit above 20%, currently 21.09%.
And do you think the naira redesign is going to do justice in mopping up all that excess liquidity?
It won't. The reason why it won't do justice is because the argument that you have more cash outside of the banking system than you have in the banking system is not tenable. And the reason is because the financial inclusion in Nigeria places the level of banked to the unbanked at less than 50%. So the question is, when you look at global precedents, you ask yourself, is it a bad thing to have cash, so much cash outside of the banking system because you have an informal economy that has a majority over the banks? Is it a bad thing? No. The answer is no. It's not a bad thing to have so much cash outside of the system. So you using naira redesign as a means to mop up so much cash in such a short window, saying that within the space of 90 days, you're going to mop up 2.7 trillion banknotes, yeah? And it's very close to an election. It's going to create some kind of cataclysmic effect that we've not even started seeing the impact yet. I don't agree with the CBN's position that the way to curb the problem that you currently have, considering that the central bank continues to give the federal government ways and means lending, overdrafts. They continue to do it. It's not a viable solution at all.
And, you know, talking about that informal economy and all of that money that's outside the banking sector, if that continues, wouldn't that make it hard for the monetary policy, policies to actually, take effect on the economy?
So here's the problem. And this is what the IMF, the World Bank, several people have continued to encourage the Monetary Policy Committee of the Central Bank, that you cannot keep raising the monetary policy rate, which is currently 15.5%. It's been raised by 400 basis points over the last 12 months. You cannot keep raising the MPR, and the fact that they've raised to 15.5% means that the rate at which they give the commercial banks money is 16.5%. And you're trying to align that inflation to interest yield curve. You cannot keep raising the rates as a means to fight inflation if you keep doing what is eating the economy and causing inflation in the first place. It's like you saying that you're going to turn on your gas cooker at home, yes, and you stand the risk of an explosion. You want to stop the risk of explosion, but you don't want to turn off the gas. That's what the Central Bank of Nigeria is doing. So you open the tap for you to meet up the budget deficits of the federal government, which has risen to 11 trillion naira, and the government expects to only have 2 trillion naira in revenues to be able to plug that gap, which means that whoever becomes president in 2023, for you to plug the budget deficit, you need to borrow $20 billion or find $20 billion in some way to to plague the budget deficit. So how do you intend to slow down inflation by raising MPR when you keep doing the very thing that is causing inflation in the first place?
All right, Kelvin, what do you think is the realistic way now to tame inflation in Nigeria?
So the inflation is both cost push and demand pull. I don't agree with the idea that inflation is only demand pull. It's both cost push and demand pull. The practical solutions are broad. Number one, the federal government needs to float the exchange rate, and adopt a floating exchange rate mechanism. Needs to amend the Finance Act and move from inflation targeting to price stability. The federal government needs to understand, and this is also advice to the Central Bank of Nigeria. They need to understand that the exchange rate contributes 70% to the cost of inflation in Nigeria because of the imports that goes into production and consumption in Nigeria. Now, for you to be able to stabilize the rate, you need to float it. You need to bring in FDIs as certificate of capital import register with NOTAP. You need to bring in NXP proceeds from companies who export, who currently are diverting or buying machineries abroad and bringing it into Nigeria to sell it, to avoid selling at the official market window, as a means to create liquidity of FX in the system and stabilize the currency. When you do that, what will happen is that the level of inflation, it begins to teeter, as it begins to slow down. The Central Bank of Nigeria needs to really focus on its open banking as a way to bring in the informal economy into benefits of the banking system, which is one of the 4 benefits: credit, loan. You cannot deny the fact that today, as we speak, access to credit is a major problem for businesses to be able to create products and value in the economy. So you need to focus on increasing government revenue so that you don't accumulate a system where there's so much budget deficit and the government has to rely on CBN ways and means lending window, which is heating up the economy and causing inflation. It is my belief that the direct intervention programs that the government has run through the Presidential Fertilizer Initiative, through Anchor Bora program, has not been successful. And one of the major defects that it has is the fact that the structure, the financial model of that direct intervention is flawed. It's a model where the central bank, that is a lender of last resort, becomes a lender of first resort and resorts to becoming like a guarantor, a 100% guarantor of the loans it gives out to all kinds of companies and loans that are not verified, and that has currently a huge NPL, a huge hole on the balance sheet. It creates like a systemic and institutional risk to the Nigerian economy. So the Central Bank of Nigeria needs to move away from direct intervention programs to allowing the financial institutions and commercial banks to lead and have the credit guarantee companies, the CGCs, as guarantors or obligors that will carry the risk of those systems. Because the Central Bank of Nigeria is not designed to lend money to individuals and to businesses. It's a lender of last resort, not a lender of first resort. So imagine what will happen when the likes of Fitch, Standard & Poor's, and Moody's are sitting in a meeting with CBN officials and they're reviewing the balance sheet of the central bank, and they're asking them, how come you have 500 billion, for example? How come you have 3 or 500 billion hole in your balance sheet? And they say, oh, we give out loan to 20,000 companies that are into production of food, and you can't really measure the impact. And you can imagine the kind of systemic risk that creates in the economy. So that model needs to change. For you to be able to create production and solve the demand pull problems that the economy has, to raise production, you need to focus on the financial model through which credit is given to the real economy.
But we saw the IMF, made some recommendations to the CBN. One is for the CBN to allow banks, determine the buy-sell rate in the forex market. How do you see some of these recommendations?
I think that the idea of allowing the banks to take the lead on the rates through a system called willing buyer and willing seller is a masterstroke. It's an idea whose time has come in Nigeria, because the things that we've always feared, that if you float the exchange rate, naira is going to go on a free fall, it has already happened. Naira is on a free fall. Naira is trading between 780 and 790 naira today. If you have an economy, for example, where the government has his own subsidized FX rate that he gives to people that he knows and his cronies. And then you have the official market, the parallel market, which is the real market backed by liquidity. And there's a huge gulf between it. You're going to have arbitrage. You're going to have round tripping. You're going to have all kinds of corruption and issues because there is an incentive to do so. People are going to find a way to game the system, both from within and without. And that's the problem. So on the recommendation that the governor of the central and his team should float the exchange rate and adopt the fixed floating mechanism, it's a masterstroke. It's a good idea. It's something that the World Bank president also had recommended to the BP months ago when he traveled to DC for meetings. But on the idea that the IMF says the Nigerian government should raise, Federal Inland Revenue Service should raise value-added tax VAT by 100% from 7.5 to 15%, I think it's a bad idea. And the reason is because there's so much pressure on the economy now. This is not the time to begin to align Nigeria to SSA countries in ECOWAS on the tax structure benchmarks in ECOWAS. I think VAT is around 20% in Ghana, if I'm not mistaken. This is not the time. There's so much pressure on the people. This is not the time to raise VAT from 7.5% to 15%. On some other ideas that the IMF made concerning banking structure, the banking structure in Nigeria, about the NPL of banks, weighted average, the fact that it's dropped from double digit to single digit. There was a time, when First Bank, for example, had the highest NPL at somewhere around 27 to 28%, and that has been down currently to around 5.66%. I think it's a good idea, but I also think the Bankers Committee and the Bankers Committee needs to pay attention to the fact that the capital adequacy ratio of Tier 1 banks is too low. In my opinion, at 15%, the Tier 1 capital, additional Tier 1 capital is too low because considering the fact that since the banking recapitalization, there's not been another recapitalization events to reduce, in my opinion, the number of banks and go put them through stress tests. I think there's something that they need to revisit because when you look at the fact that the total risk capital over the total risk weighted average of Nigerian banks, it places the banks at a systemic disadvantage. I'll give you an example. You look at Access Bank. Access Bank has 18% of all banking deposits in Nigeria. Access Bank's capital adequacy ratio is somewhere around 17.5%. GT Bank is at 22%. In my opinion, the capital adequacy ratio of Tier 1 banks should not be lower than 20%. This is going to create some kind of stability and ensure that if there is any stress in the future, the banks can go through it. Stress test is something that central banks conduct for these major Tier 1 banks to see that they are healthy and that if there is any shock to the system, that they can weather it. So, on those recommendations, the IMF also made a recommendation about the intervention programs of the Nigerian government, Presidential Fertilizer Initiative, and Cobras program. I don't agree with the IMF that has been successful. Social investment programs like conditional cash transfers, I don't think those programs have been successful. I think those programs is fraught with a lot of corruption and lack of transparency, and the impact is something that we don't see on the ground. Because if you see the impact on the ground, you realize that we can't have those programs working, and 133 million Nigerians, or 63% of the population, in multidimensional poverty. Their per capita income, for example, has dropped by 47% from about $3,099 to $2,100 within the last 8 years. So how can you, on one hand, be praising the federal government and saying that their intervention programs are successful, and on the other hand, their per capita income has dropped by 47% in 8 years? And as we speak today, 133 million Nigerians do not earn up to 1 million naira in a full year.
Quite incredible. All right, we'll be watching out. We have the final MPC decision meeting for the year. That's later today. We'll be getting that decision. I'll be looking out for it. But thank you so much, Kelvin Emmanuel, CEO, Derry Hills. It was great having your perspective.
Thank you, Larry. I appreciate the opportunity.
Thank you.